Why the stock market hasn't crashed, the illusion of stability in a devalued world. 1. The paradox of prosperity. Look around, markets breaking records, portfolios rising, optimism everywhere. But underneath, the math screams collapse. The total U.S. stock market value stands around $66 trillion, while GDP is just $30 trillion. That's a Buffett indicator of 216%, far beyond the 115% level before the 2000 dot-com crash. So what does that actually mean? It means the market is trading at twice the size of the real economy, valuations that defy logic, history, and sustainability. Yet, instead of falling, it keeps rising. Footnote. This section introduces the core valuation paradox, how U.S. markets exceed rational economic output by over 200%, historically signaling collapse. 2. The hidden inflation bet. Investors aren't blind, they're betting on inflation, not productivity. When prices rise, corporate earnings appear to rise too, even if output doesn't. It's the illusion of growth through currency devaluation. Imagine this: a company sells a product for $100 and makes $10 profit. Inflation doubles prices. The same product now sells for $200, with $20 profit, earnings doubled without real growth. Stocks rise to match the new reality, but it's all nominal. So what does that actually mean? The stock market's strength isn't real, it's inflation dressed as prosperity. Footnote. This section explains how inflationary currency policies create the illusion of rising corporate earnings despite stagnant productivity. 3. The government engine. Every year, the U.S. government injects $7 trillion into the economy, $5 trillion in tax revenue plus another $2 trillion in borrowed spending. That money flows through Social Security, Medicare, defense contracts, and public programs straight into the hands of consumers and corporations. Those dollars don't vanish, they circulate, boosting profits for the same major firms dominating the stock indexes. The government effectively acts as the market's largest customer. So what does that actually mean? The economy is on fiscal life support. The market isn't thriving, it's subsidized. Footnote. This section highlights the role of continuous deficit spending in sustaining market valuations through government-driven demand. 4. The new Cold War economy. Since 1945, the U.S. has used economic and military power to anchor global order. But new challengers, China, India, Russia, and BRICS-aligned economies, are rewriting the rules. The American response? Spend aggressively to maintain dominance, no matter the cost. Every borrowed dollar today is a geopolitical defense mechanism. The U.S. prints, borrows, and spends to project strength abroad and buy time at home. So what does that actually mean? The no-crash illusion is political strategy disguised as financial stability. Footnote. This section links U.S. deficit spending to global strategic competition and delayed market correction. 5. The devaluation loop. Flooding the system with borrowed money devalues the dollar. More dollars chasing the same goods equals higher prices. But those higher prices make corporate revenues appear stronger, sustaining high market valuations. It's a feedback loop. More spending, weaker dollar. Weaker dollar, higher prices. Higher prices, inflated earnings. Inflated earnings, higher stock prices. So what does that actually mean? The market is rising not in value, but in denominated illusion. Footnote. This section explains the cycle of devaluation fueling artificial equity gains. 6. The wealth divide mechanism. Who benefits from inflated markets? The top 10% of Americans, who own nearly 90% of stocks. For everyone else, wages lag behind inflation. Costs rise faster than income. The dollar buys less. So what does that actually mean? Market growth is not shared prosperity, it's a transfer of wealth from wage earners to asset holders. Footnote. This section identifies asset inflation as a key driver of inequality under modern monetary expansion. 7. The Coming Reckoning. Warren Buffett, sitting on over $200 billion in cash, knows the cycle's end is inevitable. The artificial expansion can't last. When interest costs crush federal budgets or inflation reignites, the correction will be brutal. And yet, the timing is uncertain. Until confidence cracks, the illusion holds. Overspending continues. Markets float on air. But when it breaks, those prepared, those holding hard assets, cash reserves, or alternative stores of value, will buy the future at a discount. So what does that actually mean? The crash is delayed, not denied. Every illusion ends when belief runs out. Footnote. This section concludes that the lack of a crash reflects systemic postponement, not genuine stability. 8. The choice before the crash. You can't stop the cycle, but you can choose your side. Doing nothing means watching your savings melt in slow motion. Acting wisely, diversifying, hedging, and building assets that outpace inflation, means surviving the reset. So what does that actually mean? The game is rigged, but it's not unbeatable. Understanding why the market hasn't crashed is the first step to protecting yourself when it does. Footnote. This section emphasizes personal strategy and awareness as the only defense against systemic devaluation.